Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review, this time for the week ending August 18, 2023. Let's start with a look at this week's markets at the close on Thursday. Lots of red on the screen. You have multiple factors playing at once. You have some risks in China that are getting pretty serious. We'll discuss that in a few minutes. The prospects for inflation being stickier for a while, meaning that central banks will keep rates more elevated over the next quarters, maybe all the way to the end of 2024. This is a risk that's getting priced into the market. It's been our base case scenario for a good while, but now markets are starting to integrate that. So rates higher, negative returns on bonds, and higher rates starting to weigh on the markets. Of course, we've been skeptical about the perspective of the market up move this year, having that much legs. At some point, the AI story seems to be has lost some of its luster already. The spread of momentum throughout the index also seems to be deteriorating. Market breadth is deteriorating, and unless we have strong surprise today, we should have now 3 consecutive weeks of negative returns on the S&P 500. The TSX is underperforming this week. Year to date, still have very healthy returns on the Nasdaq in particular, but elsewhere, we're starting to see some profit taking, which is bringing the returns down towards single digits for EFI, for emerging markets, and still for the TSX. Oil lower, Canadian dollar, euro lower, price of gold lower, so not much refuge this week. Canadian inflation, let's talk about it briefly. Last week I mentioned that in the US inflation had rebounded. Maybe it will be less sticky than in Canada, so we can dig into that this week. So as you can see here, we've been very vocal about that for a while. You need to look at total inflation, but month over month this year, because the base effects compared to last year, which was a strong inflation year, well, they kind of hide the picture. So you've seen the total level of inflation year over year fall from 8% plus to 2.8% last month. Now we're rebounded to about 3.3%. But month over month this year has been pretty strong on the inflation front, and now this month we have close to 0.6% inflation on the monthly basis, which is again too hot for comfort. And if we go on the chart on the right, I've used that a lot of times this year. Since the beginning of the year, it was pointing towards inflation falling until the summer and then picking back up. Now that we're almost done with the summer, unfortunately, if you look on the right, you see that all of the scenarios, if we have, starting from today, every single month being giving us 0.4% inflation on a monthly basis, you have the red line, and then 0.3%, 0.2%, 0.10, and then all the way to minus 0.3. What kind of inflation profile will we have by the end of the year on a year-over-year basis? And as you can see, if we have even 0% inflation month over month by the end of the year, we would still end the year at 3% plus inflation, so above the top of the range of the Bank of Canada. And the long-term average is about 0.3%, 0.3% per month. So if we have these, we should have inflation that ends the year above 4%. So again, too hot for comfort, which should prompt the Bank of Canada to remain hawkish, to maybe go even ahead with one or more than one rate hikes by the end of the year. So we're not out of the woods yet on the inflation front. There's gasoline prices that are also at play, been rising recently, so adding to the inflationary pressures on a monthly basis. There were some temporary factors this summer, like travel inflation was higher. Of course, it's seasonal, but you have other factors that are more resilient, and more resilient even here than in the US. So if we go to the next chart here, some components are stickier here. Food inflation is higher in Canada than in the US, and it's still positive on a monthly basis. So it's not about greedflation necessarily. It's not a study that we've done, but lots of these studies have been done recently, and it suggests that it's not really the case. It's global warming, climate change is a of course pushing prices higher around the world, but in Canada it's even higher because of the fall of the Canadian dollar over the last few years. 2023 versus 2022, the CAD is lower, so this is making imports more expensive here, and this is creating some more food inflation. So the Canadian dollar remains lower now than in 2022, so this is a tailwind for food inflation. And on the right, well, health and personal care inflation, demographic change. We have a public system, so the older the population get, the more pressure there is on the public sector. Wage inflation also in the public sector is fueling that, so we have this type of inflation that is higher than in the US, and it is stickier, and it should keep inflation high until the end of the year. So you really need to make a strong case for a deep recession or the economy stalling in its tracks for inflation to, by the end of this year, fall below 3%. So now in the US, very quickly, we have the leading indicators that continue to deteriorate. The Conference Board, they published two indices. There's the leading index and the coincident index, so they look at different components of the economic data. And the forward-looking data, so the leading index, continues to contract compared to the coincident index, and this is the ratio that we have here. Just look at the dynamics of this thing. The shaded areas are recessions, so you see how persistent is the deterioration of the leading indicator versus the coincident indicator. There's no official threshold, but typically when you have this kind of behavior, historically that tends to end in recession. So again, back with the recession theme, we don't think it's the deep recession that's ahead of us. We think it's just a likely recession that will be a result of all of this tightening of monetary policy and these indicators. Even though right now the economic data remains resilient, when you look at the leading indicators, it paints a picture that historically doesn't lie. So I just wanted to throw this out there. Now for China, very tough week. Multiple stories going on, so just quickly, because there's just so much here, but this week it was Country Garden, another property developer that at some point was the largest in China. Evergrande also at some point was the largest in China, so lots of volatility there, but it's preparing for a default that would be $200 billion in unpaid bills that could become systematic. Of course, China, Evergrande, that was a similar story earlier this year. Now it's officially filing for Chapter 15 bankruptcy in New York. So you're starting to have some key players that are falling that could create a wave of defaults in China, so it could help the credit cycle in its tracks, and that could be very important for the global economy and global markets. More on that in a minute, but some more news from this week. A team from JP Morgan are warning of a vicious cycle that could be started by this. They also remind us, and we've discussed that early this year, but it's a topic that's been under the carpet for a while, it seems. But cities in China have lots of debt, and they estimate, not our estimate, but JP Morgan estimate, that about 80% of these cities could not be able to repay their debt, not just the coupons on their debt, but the whole principal of their debt. So you have something that's very systematic that's brewing there. Tencent, tech company in China, disappointing in their warnings. Shadow banking, so alternative banks are looking at debt restructuring, which leads China's government to put a task force in place to avoid systematic defaults, and also it's tackling a weaker yuan, and investors are looking to get out of China as China's looking to prop up its currency. So tough week in China. And why this is important, it's not just, I know China is far away from Canada, but it's important because it has a strong link to the global economic cycle and to market action. So here on the charts here, you have China's credit impulse, which is its credit cycle. On both sides, that's the red line. It's the same line on both charts. And as you can see on the left, it tends to lead the global economic cycle by about 9 months. Until recently, because now the weight of all of this tightening of monetary policy seems to have been stronger than the impulse in China, because China's credit impulse has been positive recently, but now it's starting to turn, and with all of the news that we looked at, we could see a strong downturn ahead of us. but that's not something that's going to be helping the global economic cycle for sure. This is a chart on the left, and on the right, the relationship is even tighter with the ratio of global stocks to bonds. So you take the price index of the MSCI All Country World Index, so the total stock market, you divide it by the global bond index. That gives you the blue line. So when it goes up, that means that you have positive returns year over year for stocks that are higher than bonds, and when it falls, that means that bonds are outperforming equities. So that's kind of the logic here, and see how tight the relationship is, and if we have a deterioration in the credit impulse, which is quite likely with everything that we're seeing here, well, you could have a strong rotation from equities to bonds. So that means bonds outperform, stocks underperform, and you have a very different kind of market. So why it matters, there you are. So we'll be following that. It's a very fluid situation, but China does matter for economic data and also for market behavior. What to watch next week in Canada? We'll have retail sales. In the US, we'll have the S&P Global US manufacturing PMI, should be stable at about 49, just below 50, so in contraction zone. And durable goods orders fell negative 4% in July is what is expected. So where to find us? ia.ca/economy. You have this review, you have the podcast. We also have social media, and on the iagam.ca webpage, you can have our monthly, you can have the weekly. So there's ample material there for you. So it's always a pleasure to serve you, and I'll be back again next week.